Very good. Appreciate it as always, Coach Matt. Now let's move into our last segment here today, and it's going to be called Jedi Options. This is something we started probably 2-3 months ago, I think beginning of the summer, something like that, Tyler. And I really, really love it. One of the strengths you have as an educator, as a coach, as a trader yourself is in the options market. I mean, you go in, you understand implied volatility curves, you know how to build these different strategies, and you really know how to teach them. And so what Tyler does each and every Wednesday, if you're brand new to our channel, is he goes deeper into some kind of strategy or idea in the options market, kind of helps us understand it and gives us some ideas as well that might be tradable. So Tyler, what do you got here today planned for us?
Yeah, so I'm going to do just a quick little lesson on a bull call spread strategy. And then I'm going to show a stock that I think is an appropriate example, good case study of a pattern that I think lends itself well to this particular strategy. And specifically, I'm going to explain why we like the bull call, because originally we were thinking maybe covered calls, but stumbled upon this particular stock and thought it was a good example to present and say, hey, this is a scenario where even though I love cash flow and I prefer the higher probability stuff, if I ever were to get a little more directional, a little more aggressive, it's going to be with this type of setup. So that's where we're at today. So I'm going to pull open, I'm going to take a few notes. All right. I'm going to take a few notes here. I think it's good to be organized. There's a couple of different ways to explain a bull call spread, and it has a couple different names as well. So you got a few different names that you could use. You'll hear this referred to as a bull call spread. It's also known as a long call vertical spread, or you're buying a call vertical spread. And it's actually a very simple strategy if you already understand how to buy a call option, right? So step one is, oh, and by the way, your bias when you do this, you're like moderately to aggressively bullish. Okay, this is not mildly bullish. We're expecting a pretty nice move in the stock. So I want to swing for the fence, but I'm not crazy. Like I'm not going to straight buy a call. I'm not like mega bullish, like in between. So moderately to aggressively bullish. And I would love if options are a little cheaper. So low implied volatility signifies that options are a little bit cheaper. This is a debit spread. I'm paying to get in this trade. The cheaper the options, the less I'm going to have to pay. So that's kind of the bias. Okay, so the structure, the first thing you're going to do, and that's how I would explain this, is just step one, step two. Step one is you're going to buy a call option. You're bullish enough to buy a call because you think the stock's going higher and calls are somewhat cheap. And you could stick with that. You could just straight buy a call. You have unlimited reward. But you're paying a decent amount, even though it's cheap, you're still just straight buying option. So you got to pay a little bit. If you wanted to reduce the cost, you could sell something against that call option. The other reason why you might want to sell something against the call option and create a spread is because of time decay. When you buy a call, you're fighting theta, you have a negative theta position. So time decay is hurting you. You're also quite sensitive to changes in implied volatility. So if you want to mute your exposure to both time decay and volatility, you turn this into a spread. And so step two is we're going to sell a call option against the one we purchased. And specifically, because you got a lot of different calls to choose from, you're going to buy a lower strike call option. Okay, lower strike. Usually it's around at the money. Okay, so lower strike, comma, near the money is what we're going to say. Going to be close to at the money, maybe a little in the money, maybe a little out of the money, but right around the current stock price. And then you're going to sell a higher strike call, and it's going to be out of the money, right? Out of the money, call option against the one you purchased. Okay. And so say I buy a call for $5, sell one against it for $2, that reduces my overall cost to only $3. So instead of paying $5 and having $5 of risk, I now have $3 of risk. So these are easier trades to actually not need a stop loss on. If you can structure this cheap enough, doesn't matter if the stock blows up, you just lose a little bit of money, which is another, I think, perk for this type of strategy. So that's the basic idea. Let's build one, and let me set the stage with this particular stock. So at Tackle Trading, we have a list of stocks that are usually prime candidates for covered calls. We like the fundamentals. They have good options available. The call premiums are decent. So I was where this stock came from was the Tackle 25 list, but a little bit of backstory as to how it might have got onto my radar. One of the things I like to do on a daily basis is look at my watch list, both stocks and ETFs, sort by percent change, and see what's moving, right? What's moving. And one of the stocks that I saw was moving today up 7.5% was United States Steel. And I know that stocks, especially steel stocks, basic material stocks, they're sensitive to what's going on in their sector and industry. So I thought, oh, steel stocks are moving today, which is nice because they got beat up a little bit yesterday. So I wanted to look at steel stocks. So I went over the Tackle 25 list, and the steel company on that list is Steel Dynamics STLD. So I say, oh, okay, so Steel Dynamics is up today. It's green. And not only is it up today, because really screw one day's performance. I mean, what does that tell me? I want a good trend. So Steel Dynamics, again, not only does it have a good bar today, it's got a lovely little trend. I mean, take a look at this nice little high base here. Actually, more than a high base. This is more of a trading range, multi-month trading range. You get a little breakout right here. Got a little breakout on high volume, showing institutions coming into the fray. On the news and kind of context backstory for steel stocks, you've got an infrastructure bill that's in the works right now. I think that has renewed interest in steel companies. If you missed the breakout 4 days ago, you're like, oh, that sucks, I missed it. Please, Mr. Steel Dynamics, come back, give me a buy the dip setup. Come back towards this 67 level. Maybe old resistance becomes new support. Steel Dynamics is like, yeah, you got it, man. Here you go. I'll give you a little multi-bar pullback, 3 days down. There you go. Well, what more could you want? Like, that's exactly what you wanted for. So you got a lovely little bull retracement after a big breakout. Weekly chart also looks delightful. Really good breakout last week. Little inside bar for this week, showing you're digesting the move. It's healthy. It's healthy. And so why not do a covered call? You could do a cover call here. I don't mind a cover call. The question is, how bullish are you? And which strategy do you think is going to best suit your bias? If you're mildly bullish, sure, do a cover call. But this is a pretty sexy setup. It's in a really good sector and industry particularly. Steel stocks are hot right now. If ever there was a time to go a little more directional as a cash flow trader, it would be something like this. It would be something like this. And so perhaps the bull call spread is more appropriate, gives you a better risk reward than just settling with a covered call. Because by the way, if I was going to sell a covered call, I'd be buying the stock and selling like a September 75 strike. And when you run the numbers, it's around a 10% return, which is pretty good for a covered call. It's really good for a covered call, actually. But I'm a greedy bugger, and I like the setup. It's one of the better charts in the market. Looks nothing like that poor Russell 2000, right? Looks better than the S&P. You got relative strength here. So, I don't think you can find a better pick, quite frankly, from a setup perspective. Whether or not it works, we'll see. But maybe worth me opening up the risk graph and having more than a potential 10% return. That's the motivation for the bull call. When you look at the options implied volatility, it's not particularly low. But one of the things you'll discover about IV is it's one variable. It's not the end all be all. I can still structure a pretty compelling bull call spread, even though the vol might be a touch higher than what I would like on paper. Okay. But we'll find out. I build the strategy and I see what the numbers look like. And that in turn kind of tells you if the little bit higher IV was a deal breaker. So essentially what I'm going to do is I'm going to buy an at the money call. I'm going to buy the 70 strike call option. Hoping the thing goes up to 75, 80, 85, hopefully $100. I want it to go up a lot. And from a month perspective, I got lots of choices here. September, November, January. If you do a really long-term call spread, it's going to be like watching paint dry. It won't move very quickly. Obviously, I can't do August because there's only 2 days. I don't want to watch paint dry. So I don't want to do like a 6-month bull call. Okay. October would be the sweet spot for me, a little 2-month bull call spread. I'm like, I want resolution relatively quick. And I think if I'm wrong, I'm going to get out. And so I'm actually going to do September because I think it's a little more aggressive. But honestly, what would help me make the decision though is to build the trade out in 2 different months and see what I think. So let's start with September. Maybe I'll change my mind. We'll see. I want to buy the 70 call right here. Okay. It's going to cost me about $3.50. And I could be done, by the way. I could just say, look, Steel, I love you. I'm just going to buy a call, go to the moon, make me happy. You could just buy a straight call, but you got to pay $350. So the appeal and the carrot, right? The incentive of selling that higher strike against it is you reduce the cost. Now, if I'm going to do this for September, I don't know that I want to sell the 80 call for 60 cents because that doesn't reduce my cost that much. If you do September, I think I'm going to have to do a 70-75 bull call. So buy the 70, sell the 75. That would cut the cost like in half. Now I'm paying $1.85 for a $5 spread. The delta difference between the two is about 22. That would be my net delta, about 22. I don't mind that trade. And it only requires Steel Dynamics to get up to 75, which is completely doable in the next 30 days. The only other consideration or alternative I might entertain is going out to November, giving it a little bit more time. And if that were the case, I'd probably widen the spread. I'd still buy the 70 strike, but I'd sell the 80 against it. You're paying about $3.50 and you're shooting for a $10 wide spread. So risking 3.5 to make 6.5 instead of risking $1.85 to make 3.15. That would give you more potential upside, although it's a little bit more expensive. Your net delta is also pretty good on that. 53 and 29, you got about 24 net delta. If I'm doing my math right. I like either one of those. I think they're both checking most of the boxes here. Tim, I could get into the risk graph here in a second if you want, but that is my initial kind of intro to the bull call.
I was just sitting back watching. I loved that what you just did there. I want you to go back to the trade tab if you can for just a minute, because I do have a couple of thoughts. And thank you, Tyler, number one, for walking us through the technical pattern as to why you liked it, going through the whole process there, and then building out the spread. To me, the November is the choice. I understand your instinct to go to September because of your management skills, right? And because you're going to be micromanaging this as a short-term trade based on technicals, trigger points, step system type of principles, right?
Yep.
I think I want to have a little bit more time. And one of the reasons I want a little bit more time is when I'm in a spread, $70 is the anchor strike itself. And so you actually are, and you know this, we're carrying time decay on the 70. It's not a lot, but you are carrying time decay on 70. Since it's right at the money, you're essentially buying a bear call spread somebody's selling to you. They're capturing a 30-day time decay trade, and you're betting on the upside with delta and that you're going to offset theta. I'll just take the balance because I agree. I would not go out to January, and I understand why a trader might use September here, but I would take the balance of November to where I still get the delta I want. I can open it up to a 10-point spread, which for me personally allows me to kind of manage it a little bit more like that $10 target that I might be looking at. I mean, the stock can fly, if it wants to. If that chart technically confirms, I kind of want the upside. And as a percentage of the spread, if you look at this, $1.80 against 5 is not cheaper than $3.40 against 10, right? Because if you flip that to 2 contracts, you're still basically paying the same amount of money for the 5 versus the 10. I'd go November. I'd choose that one. I love the conversation though. And I think it always does really help any new student out there in the options market when you compare one against the other in a very similar vein and talk about those subtleties, right?
Yeah. I mean, when you first learn a strategy, it's like, look, I just need to know, like, what are the base rules? Just tell me, how to build the thing. Forget the why. Just tell me how so I can get this under my belt. But then once you understand how to build a bull call and what it is, then this is like level 2 of your understanding, where you say, okay, now look, you understand the basic idea. Now let me help you understand why that's the default. And if you were to deviate, if you were to do a September bull call versus November, this is the implication, right? This is the trade-off. And this is why options are both complicated but fun, because there's a million different ways you can structure it. And the key from the educator standpoint is, I don't care what decision you make. I just want you to make an informed decision and understand why you did it. And as long as you understand the why and you're comfortable and you like the trade-off, that's fine. Like, there is no right way of doing it to a certain extent. So your logic is sound on the November. I have no problem with that. Yeah.
Matt, any thoughts on this STLD bull call directional play that Tyler's been mapping out?
Yeah, a couple things. Number one, love the setup on STLD on both the weekly and the daily time frame. You gotta love the weekly channel breakout, and then the bullish retracement that's fighting for some confirmation here. It's in a good zone from a technical perspective, and when you're looking at whether you're a +1 or a +2 technical bias, a bull call spread certainly does fit from a technical perspective. So that's number one. I just want to say, more than anything, though, is thank you for the conversation, guys. Really thoroughly enjoyed the discussion between the two time frames, September versus October, and why both of you guys like the one or the other. I think it was very fruitful for a lot of people. So just thank you for the conversation.
I appreciate that. Hopefully people got value out of it. I love this segment, Tyler, and great job on STLD here today and mapping that out. If you want more education on bull call spreads, I would recommend checking out, the playbook at Tackle Trading would be a great place to start, or to jump in Tyler's trading lab, which he holds each and every Wednesday. Actually, you'll be holding that here in about an hour and 20 minutes. You cover topics like this quite often, right, Ty?
Indeed. It's, might I say, the best hour of your week. I mean, you should come join. You'll like it a lot.